All right, let's get right into it. Today, we're tackling what is, and I'm not exaggerating here, probably the single most important topic in all of trading: risk. But we're not just talking about how to avoid it. We're talking about how to actually use it, how to turn it into your biggest, most sustainable edge in the markets.
And listen, the stakes are incredibly high. Just look at this quote from the elite trader Lucky Chart Ape. This isn't just some abstract theory. He's saying this is literally the line in the sand between turning a tiny account into millions or just blowing it up completely in less than 2 weeks. So yeah, you're going to want to pay very close attention to this. So here's our game plan. We're going to walk through 5 crucial ideas. We'll start with the 2 paths every single trader has to choose from, and we're going to end up discovering what your true edge in this game really is. Let's get started.
Okay, so first things first. Every trader, when they start out, stands at a fork in the road. Path number 1 is the path of trying to predict the future, trying to be right. But the other path, that's the professional's path, and it has nothing to do with predicting and everything to do with managing probabilities.
This right here, this is the first huge mental shift you have to make. I want you to completely forget about your win rate for a minute. Seriously, being profitable has almost nothing to do with how often you win. It's all about the simple math of your wins versus your losses over a long series of trades.
And that idea leads us straight to this really powerful kind of counterintuitive concept. You can actually lose way more trades than you win and still be wildly profitable. How does that work?
Well, the secret is something called asymmetry. It sounds complicated, but it's not. All it means is that you set up your trades so that the potential profit is many times bigger than your potential loss. This is the engine that drives all long-term trading success.
And look, this isn't some made-up example. This was a real trade from Lucky Chart Ape. On a tiny $200 account, he risked just $4, for the chance to make over 100. Do the math on that. That trade had a risk-to-reward ratio of 26-1. Think about that. For every single dollar he was willing to lose, the potential upside was $26. That is some serious asymmetry.
Now, let's see how this plays out over time. You see, pros think in terms of R, which is just their standard unit of risk. So if your system is looking for trades that can make you 10 times your risk, or 10R, you can literally lose 10 times in a row, losing 1R each time, and then just one single winning trade makes you break even again. It's that powerful.
I mean, let this sink in. You can have a system where you are wrong 80% of the time. 80%! And it can still make you an absolute fortune. It's not about how often you're right. It's about how much you make when you are right versus how little you lose when you're wrong.
But, and this is a big but, to get to those big winners, you have to survive long enough to catch them. And survival in trading, it has nothing to do with luck. It's about the cold, hard, mechanical rules of risk management that keep you in the game no matter what.
And the bedrock, the absolute foundation of survival, is uniform risk. It means you risk the exact same small percentage of your account, like 1 or 2%, on every single trade you take. No exceptions. It's not about how you feel about a trade, it's a mechanical rule. This is what stops 1 bad trade or even 10 bad trades from knocking you out of the game.
And here's how you do it mechanically. It's just 3 simple steps. 1, you find your entry price. 2, you decide where your idea is proven wrong. That's your stop loss. And then 3, this is the magic part, you calculate your position size so that if you do get stopped out, you only lose that fixed amount you decided on earlier. Remember this, your gut feeling doesn't determine your position size. The math does.
And look at how this works. Let's say your risk is $4 per trade. It doesn't matter if you use a really tight stop or a really wide stop. The dollar amount you stand to lose is always $4. The only thing that changes is how big your position is and what your potential reward could be. The risk stays constant.
All right, now for some tough love. You have to burn this into your brain. Losing streaks are not a maybe, they are not a possibility, they are a 100% mathematical certainty. They are going to happen to you.
Don't believe me? Lucky Chart Ape ran a simulation on a profitable system. And in one of those simulations, it spit out 18 losing trades in a row. Now imagine you were risking 10% on each of those trades. You'd be toast. But if you're risking just 1 or 2%, you survive. You live to trade another day. That's the whole point.
So once you've got the math down, that brings us to the next level, the psychology. Because surviving is one thing, but actually thriving in this environment requires a totally different way of thinking. And here's the difference in a nutshell. The amateur trader is obsessed with each and every trade. Did I win? Did I lose? They're on an emotional roller coaster. The professional? They couldn't care less about any single trade. They are obsessed with one thing and one thing only: flawless execution of their system over and over again. The only question they ask is, did I follow my rules?
This quote from Lucky Chart Ape just says it all, doesn't it? When you can truly detach from the result of any one trade, you're free. You can finally focus on the only thing you can actually control, which is your process.
And here's a brilliant example of a professional process. This one from the trader Moneytaur. You see how the risk isn't just random, it's structured. It's based on the time frame of the trade idea. So higher time frame plays, things that last weeks or months, get a bit more risk, and lower time frame plays, the scalps, get much less. It's a disciplined, logical framework.
Okay, so let's tie this all together. We've gone through asymmetry, we've talked about survival, and we've covered the professional mindset. Now we can finally answer the real question and redefine what an edge in trading really is.
So, after all of that, it all boils down to this one question. If a trader's real edge isn't some secret indicator, if it isn't having a 90% win rate, then what on earth is it? And here it is. This is the answer. Your edge is not a piece of secret knowledge. Your edge is your discipline. It's your ability to take a system that has positive expectancy, meaning the math is on your side over the long run, and execute it perfectly without emotion hundreds and hundreds of times. That is the only edge that actually lasts. And we're going to end on this powerful, simple idea from Moneytaur. Your job is not to predict the market. Your job is not to force profits out of it. Your only job is to manage your risk, meticulously, on every single trade. If you can do that, day in and day out, the market will take care of the rewards. You just handle the risk. So let me ask you, what does that change for you tomorrow?